Let me now bring on board Mr. U.R. Bhatt, Managing Director with Dalton Capital Advisors. Mr. Bhatt, good morning. Thank you for joining us.
Good morning.
Surprised with the fall?
Not really, but I think the market was heading for this, especially when the comments from the Fed were sort of beamed day before yesterday night. It was quite obvious that market will take it on its chin, because it is not anybody's argument that this monetary easing will continue forever. At some time this has got to be reversed. But even a small sort of bit of doubt as to whether this will continue is enough for the market to sort of correct so much. That shows that the market is not really standing on very firm legs. Even if you take India, about $4 billion month to date has really brought down the market by about 3%. So therefore, we need more and more of money power from FIIs to keep the market where it is. So that is not a very good sign. But all said and done, it is not as if FII flows will evaporate in a great hurry, because even if the Fed is talking of potential reversal of its easing policy, it is probably at least about a few quarters away. It is not imminent. So therefore, I think there was justifiable nervousness on some talk of a potential reversal sometime in the future. But I don't think there is any imminent danger of that happening. So therefore, the market probably could revive. It's just a matter of sentiment, which probably lasts for about 48 hours.
Fair point, Mr. Bhatt, but do you think the budget could provide any relief, or do you think all the positives are already baked in?
Well, I think there's a lot of expectation from the budget, so that is what was apparent till at least day before yesterday. But there was in between some talk of further populist spending. That is what sort of spooked the market a bit. But if that is based on sound fiscal logic, at least as far as the fiscal deficit number is concerned, as far as say for example phasing out non-merit subsidies is concerned, if all these things come up and the fiscal deficit is sort of reined in, and some more development on on managing the fisc, managing the general mood of spending, and better directed subsidies, I think these things can really give some leg up to the market. So I think that's a big event going forward is the budget, and I think people are expecting a lot from the budget. But I think the finance minister is quite constrained on delivering what the market is expecting.
Mr. Bhatt, are you putting money to work, or it's too early to put money to work? What I'm trying to understand and gather from you is that what is your current portfolio strategy? Are you long, short? Are you sitting on cash?
Well, I think when you're managing a fund, you need to be invested. You cannot, you don't get rewarded for keeping cash. So what you can only do is be invested in the sort of stocks that probably in tune with your stance as far as the market is concerned, and also seek protection whenever that is required. Whenever you think the market is headed downwards, you try to get protection and see that you outperform the market. So therefore, I don't think it could be anybody's case that you, because the market is expected to come down, you sell everything and hold cash. That is not the logic that runs the funds.
Mr. Bhatt, last time when markets corrected, the bulls, they ran for cover and they decided to hide in FMCG and pharma stocks. Now that markets are correcting again and bulls are running for cover, where do you think they will hide? Do you think they will revisit defenses? They will revisit FMCG names?
Well, if you're invested in equities and if you want to seek protection when you're expecting the market to come down, they are the sort of sectors where you should really be hiding. But with the budget expected next week, so I think one has to take a view that there would be some sort of revival of sentiment, investment sort of cycle might be kick-started. I think so one needs to take a view on the budget and therefore probably be also invested in cyclicals at least till the budget is over and we know what exactly is in store. So I think it is not probably the right strategy to just be invested in defensives and wait for the market to correct. Market correction might not last very long, because as I said, if the basis of the market correction was that monetary easing might have to stop sometime, because that was always expected. It was not as if monetary easing would continue forever. But it's just some talk about that, and so as I said, it could be several quarters away, even the beginning of a correction as far as monetary easing is concerned. So therefore, I think market would probably bounce back, and so therefore one has to keep one's stance suited for that.
What is your understanding of the machinery space? Do you think in the near term for stocks like Crompton Greaves, ABB, Siemens, there is a lot of trouble. Do you think in the near term they still have a mountain to climb?
Of course, in the near term, I think there are lots of headwinds there. That is sort of reflected in the price, and probably there could be further correction. But if there is a revival in the economy post, hopefully, a good budget, I think these are the ones that can probably be the lead indicators. So I think it will take probably some time and take some more correction in the capital goods space before they start doing well, and that should be based on some fillip and some cues from the budget. Hopefully that will come about.
Mr. Bhatt, what do you think is going to be the beleaguered sector from here? Given how we've performed in the third quarter, where do you see earnings pain still persist?
I think the earnings pain is still going to persist in public sector banks, because that is one space where you have seen the NPAs going up dramatically, especially in the public sector space, and there would probably be further pain if there is further delay in recasting the balance sheets of the state electricity boards, and generally the infrastructure sector not getting sort of fillip in terms of decision making with the government. If that happens, I think there will be further pain there as far as mounting NPAs is concerned, and that would probably tell on market performance. There is a huge distinction between the private sector banks, which have been able to manage their asset side very well compared to the public sector bank. I think public sector banks have further pain going ahead in terms of further increase in NPAs.
When do you think the market mood will change, and what will change the market mood? A solid budget, global liquidity, or ultimately it has to be earnings?
Well, global liquidity has done its bit in terms of the performance of the market over the last, say, almost more than 12 months now, has been largely based on re-rating and less so by earnings growth. So therefore, I think earnings momentum is something that can take the market up from here. A good budget will certainly give the right momentum for that to happen. And so therefore, I think it should be in the order of earnings momentum, a good budget, and then continued liquidity. I think these are the three things that keep the market in good shape.
Okay, Mr. Bhatt, we'll let you go on that note. Appreciate you taking the time out and joining us on the show today.